Assalamu alaikum friends, welcome to question number 11 of SBR. So let us go through the question. So you have been given the statement of financial position and you can see that you have been given non-current assets, property, plant and equipment, goodwill, investment and associate, current assets, total assets, and under equity part we have share capital, retained earnings, other components of equity, NCI and your liabilities. Okay. Now we have accusation of Hulti and then we have accusation of Morgie. That means there are two accusations. We have agreements with CP. Then we have the requirements. Okay, so before that let us go through the requirements. Okay, explain with suitable workings how to correct the errors that have arisen when accounting for the acquisition of property. So there has been some error which you need to correct when you are accounting for Hulti. Show the adjusting entries required to correct the consolidated statement of financial position. You need to show the adjusting entries, that means debit credit. Okay, and it's for 8 marks. Next one, with suitable workings how to correct the error that have been arisen when accounting for the acquisition of mortgage. Here also same requirement, but it is for mortgage this time. The company is different. Okay. Third, again with suitable working, how the agreement with CP should have been accounted for in the consolidated financial statements. Agreement with CP. Okay. And all the three are in one place. Consolidated statement of financial position, because the first question for 30 marks is on group account. Hence consolidated statement of financial position. Number 2 for shares. Okay. So to answer number B, requirement B, the two requirements in B, you need this paragraph, the share part. Okay. So now you have a choice whether you want to attempt A or B because they are not related. Okay, so let us finish with A first. Let us go through this. Okay, so what I'm going to do is I am not going to read the whole case study. I'm only going to read the only for the first part. First part we only need the accusation of Hulti's information. So on 1st December 2003 he acquired 80% subsidiary for 600 million $1 equity shares in exchange for cash of 750 million. The carrying amount of Altus net assets at acquisition, so net asset is 960 million. Fair value definitely 20%, NCI is 250, and group policy to mission said fair value recorded goodwill asset arising in acquisition. So this is the way he calculated goodwill. Now you have to tell whether it's correct or not. Definitely it's wrong. That's why they told to correct the entry, right? Because the formula for the goodwill is consideration plus the fair value of NCI minus the fair value of net assets, right? So the fair value of net asset is 960 NCI, but this 750. Okay, it is they have told 600 million $1 share in exchange for cash of 750 million. Okay, the cash. Now we'll see there are more things to it. Okay, however, shortly after the acquisition date, accountant of Joy realized the following. What is it? The deferred cash consideration of 50 million arising on the acquisition had not been recorded by Joy. So what about the deferred cash consideration? Because we know when we acquire a subsidiary, it is not only in cash. You can pay in cash, in shares, or in deferred cash also. Okay, when you are taking the consideration, this has to be there. It was not there when we calculated goodwill. Hence, the calculation of goodwill will change because of this new information. This payment is due on which date? You have to see the date. If it falls in that date, wait, you have to make it for. But they didn't say. 30th November 2004. Okay, this payment is due on 30th November 2005 and appropriate discount rate is 10% is the discount rate. Next, fair value of identified net assets has been calculated as 980, right? The excess is the fair value of net assets over the carrying value was due to unrecognized franchise right. So franchise right is what? It's an intangible asset. That means we need the help of IS 38 to answer this. Okay, net assets with the remaining useful life of 4 years. The reason why they've given is for you to find amortization. Okay, no entries has been recorded. That's why we need to record this according to franchise right. So now we are going to answer the first part of it. Next one is required for the second requirement, so we are not going to read it now. Next, Hulti. Okay, just okay. So when you answer Hulti, Okay, but mention the name of the company. Okay, write it. Let us see what tutorial note is saying. Consideration transferred in a business combination and identifiable net assets of subsidiary at the acquisition date should both be measured at fair value. Okay, the consideration also, the net asset also, it should be at fair value. If you struggle to think about the double entries you get for this adjustment, then think about how you would process them through the standard consolidation workings and what impact this would have on the statement of financial position balances. Okay, next. So here you need to think too. You need to take care of two things. One is deferred consideration, one is the franchise right. So how are you going to answer this? You are going to answer this in two different paragraphs using two different subheadings. Okay, the first one will be deferred consideration. Okay, so deferred consideration is dealt under which standard? It is dealt under IFRS 3. IFRS 3 means business combination. Okay, all business combination relating to goodwill and CI consideration, it is under IFRS 3. Okay, says, okay, so now first how do you start this answer? You need to say what IFRS 3 says, the standard says. The standard says consideration transferred to achieve control over another business must be measured at fair value. Okay, the consideration transferred to achieve control, that is for the subsidiary, is measured at fair value. Deferred consideration should be measured at its present value. Because of that, hence, fair value means what? Present value. So this should be measured at its present value. Now this is the first paragraph. Now you see second paragraph. Okay, keep a space between this. Go to the second paragraph. Now you are calculating. Okay, present value of deferred consideration as at 31st December. Always name the year. You are finding the present value as at 1st December 2003 was 41.3 million. How? The working is right beside it. Okay, make sure that you also make this a habit, that when you write an amount, next to it only you show how you got the amount. Okay, right next to it. No separate working is required because it's not a lengthy workings are not required. Okay, so 50 into 1 divided by 1.10 to the power 2, because they told that the deferred consideration was 50 million, but it was not the fair value. Present value, they have given it the cost of capital, they have given you the discount factor 10%, right? And for 2 years, starting from 1st of December. So from on 1st of December 2003, it will be payable in 2 years time. So which is 1st of December 2005 or 30th November 2005. Therefore, it is to the power 2. Okay, 1.10 to the power 2. So 15 to 1.1 to the power 2, 41.3. So goodwill should be increased by this amount and corresponding liability recognized. What should you do with the goodwill? If anything it has an impact, you need to write it because you have calculated. Where will this have an impact? Goodwill. Goodwill should be increased. And goodwill is a debit, so there should be a liability part of it and corresponding liability recognized. Okay, liability was not there, now it will be recognized. Goodwill was already there, but the amount which you have calculated needs to be increased. Okay, so the correct entry, you should show the correct entry in forms of debit and credit because they asked for this. Okay, why goodwill will increase? Because consideration, no, you are receiving more now. Deferred consideration is also taken into account, the present value of it, so goodwill will increase. So debit goodwill, goodwill is an asset, debit credit liability, right? Because deferred consideration is a liability. Okay, it has not been received yet, it will be receiving in the future, therefore it's a liability. So credit liability 41.3, both needs to balance debit and credit. Okay, next we'll read the tutorial note. Don't forget to unwind the discount on the liability. Another thing is, whenever this such things is given where deferred considerations are used discounted using the present, okay, to find the present value, you have to unwind the discount on the liability. There's a discount on the liability also that you have to unwind, because that liability is long-term liability, on that also there's a discount. Okay, so and that is known as interest. So the interest on the liability should be charged to P&L. Where will the interest will go? So interest on that liability, which liability? This liability 41.3. What is the interest? 10% only. The present value, the cost discount factor which you have used to find the present value is only the rate to find the interest on the liability. Okay, where will it go? P&L, profit and loss. Interest goes in profit and loss account, right, as a finance cost, and it will be amount to 4.1 million. So how will this be recorded? The entry to record this in the consolidated statement of financial position is, okay, debit in return as credit in liability. Liability will be credited. Okay, because it will increase the amount of your liability by the interest, because now you're receiving the liability plus the interest. So 4.1 credit. Debit retained earnings, because it will go in the profit and loss account as an expense. So retained earnings debit. That means it will reduce the retained earnings. That's why debit retained earnings 4.1. Okay. Now, so we are over with the deferred consideration. That's how we deal with it. Now let us go to the second one, and you need to you need to write the second subheading franchise right. And now we begin. Here also same way. If you see the pattern, you know there also we started with the standard. Here also we are starting with the standard. What does IFRS 3 has to say for this franchise right? Before it was for deferred consideration. Now it is for the franchise right. Why franchise right? Because it is a part of net assets. It is an intangible asset, and it comes in the part of net assets. That's why IFRS 3. Okay, because you might be wondering that IFRS 3, sorry, franchise right is an intangible asset, then why IFRS 3? Why not IS 38? Because franchise right falls in net assets. Okay, so they say identifiable net assets of a subsidiary should be measured at, they also say as fair value. Okay, if it's a net asset which you have acquired, when net asset of a subsidiary, okay, so when you have acquired, it will be measured at the fair value at that date. That's what IFRS 3 says. Okay, so this you need to write. Now second, you're finding out the fair value. So the fair value of identifiable net assets exceeds the carrying amount. You need to do this to find whether there are any impairments or not. Whenever tangible or intangible asset is there, you need to find for the impairment, isn't it? So you need to find out whether there is any impairment or not, because the fair value of net assets exceeds the carrying amount. What is the carrying amount? 980 minus 60. Okay, it exceeds the carrying amount by how many? 20 million. 980 minus 960. Just okay, 980 minus 960. So we'll go to this one, and if you see, it was 960 here, right? The net assets, but here they told it was fair value was 980. So you see the difference is 20. Fair value is more than the carrying amount. Carrying amount was 960, fair value was 980. So the difference is 20. Okay, because it needs to be recognized to its fair value. Carrying amount was 960, so that needs to be increased by further 20 to write it till 980, because 980 is the fair value. This relates to an unrecognized intangible financial right that must be recognized in the consolidated financial statement as the acquisition date. Unrecognized, you didn't recognize it. Okay, it's an intangible franchise right that needs to be recognized in the where consolidated financial statements at the acquisition date. This adjustments reduce the amounts of goodwill recognized. You should always write the impact after you calculate. See, first the standard, then at what amount it should be recognized. Third, you do the calculation. Fourth, you show the impact. Impact on where? Goodwill. It reduces the goodwill. Why it reduces the goodwill? Please understand the logic. Don't memorize increase goodwill, decrease goodwill. How it reduces goodwill? Ask this question and then you solve it by yourself. You will understand it better. Okay? Because it is net assets. Net assets we are deducting from NCI plus consideration. So if net asset, if we are deducting a big amount, that reduces goodwill. So now because net asset has increased from 960 to 80, so goodwill will fall down because we are deducting a bigger figure. Okay, so that's why when goodwill is an asset, when you need to reduce goodwill, you need to credit goodwill. And where will you debit 20? Franchise right, it's an intangible asset. Intangible asset. Okay, don't forget the amortization. Okay, so intangible asset should be amortized over its remaining useful life. How many years it was? 4 years. So the current year charge then is to be recorded in consolidated profit or loss. Where will it go? In the consolidated profit or loss, because they told consolidated financial statements. So you need to write it. Where will it go in the consolidated financial statements? where will it go in the consolidated profit or loss account? Okay, it will be 20 divided by 4, 5 million. Okay, so the franchise right is what? It is an asset held by subsidiary, intangible asset by the subsidiary. So the charge in P&L should be allocated between the owners of the parent and the NCI based on the respective shareholding. So that charge, where will it go? It should be allocated between the parent and the NCI, isn't it? Because it is a right asset held by the subsidiary. So the charge will go according to proportion to the parent and the NCI of the amortization. Okay, relating to that franchise right in the profit and loss account. So the entry required. Okay, so what is the entry required in the consolidated statement of financial position? This is, if you are not able to show debit and credit, at least you can say retained earnings will reduce in the statement of financial position by this much, NCI will increase, intangible will reduce, like that you can say. Okay. So parent, how much they have acquired the subsidiary? 80%. Only the parent's share will go when you are taking the retained earnings. Okay. So that's why it is 5 million into 80%. It will be debited in the retained earnings because the reason is retained earnings will reduce. It's a cost, no? Amortization, like depreciation, is an expense. It will go in profit and loss account. So it reduces retained earnings. That's why retained earning is debited. How much? Only the parent's share of the amortization. Amortization is 5 million. Parent share is 80%. So 5 million of 80%, 4 million. NCI is also debit. How much? Only the NCI share. Amortization is 5, on that only 20% is NCI. So 1 million. So 4 plus 1, that means credit has to be 5 million. Okay. Only the amortization. It will be credit intangible asset. Why? Because amortization, like how you deduct depreciation from cost of asset, amortization also you deduct from the intangible asset. So the value of the intangible asset goes down because of amortization. That's why credit intangible asset, 5 million. Okay. Next, so we are done with both the things. What is next? Calculate the current goodwill. Okay, so this is the third paragraph, third subheading. Total goodwill arising on Hulti. So total goodwill arising in acquisition of Hulti is therefore 61.3 million, not what we have calculated before. Before it was, what was the value which we got? 40 million, but it is not 61.3. Okay, so how do you do that? See, 40 million draft, from the draft you take 40 million. Okay, what you have calculated before, then with that you are adding 41.3 minus 20. What is this 41.3 minus 20? That means you need to look at both franchise right and the deferred consideration. Okay, so deferred consideration was how much? You see here, you need to only see this part, what you are doing with the goodwill. Debit goodwill means increase goodwill, add 41.3. And when you go to the franchise right, goodwill was credit 20 million. That means reduce goodwill by 20 million. That means minus goodwill. So that's why from the amount which we got before it was correct. With that we are adding 41.3 because it increased, goodwill increased. We are deducting 20 million because goodwill decreased. Hence 61.3 million. Okay. So now we are going to the second requirement which is asking for the second company. Okay. Let us read it. Acquisition of Mergy. 1st of December 2001, Joy acquired 30% of ordinary share. How much? 30%. Ordinary share of Mergy for a cash consideration of 600 million. The moment you see the percentage, it should tell you subsidiary, associate, joint venture. What is it? It is a associate. It's not a subsidiary because more than 20 and less than 50. So 600 million. For 600 million acquisition, they have got it. Joy treated Merky as an associate. Okay, and you know, when it's an associate, it is equity accounted. Even if they don't write it, it is equity accounted only the moment it is an associate. Okay, so has an equity accounted for Mergy up to 1st of December 2003. Up to how much? 1st of December 2003. When you have acquired it on 1st of December 2001, that means after 2 years, till 2 years, you are taking it as an associate. Then Joyce invested in Mergy as at 1st December 2003 is still included in the draft consolidated statement of financial position. At 1st of December 2003, fair value of 30% equity interest in Mergy held by Joe was 700 million. The value increased of the associate. That means the closing balance. right? It is 705 million. That is the fair value. Okay. So on December 2003, acquired a further 40% on that date. What did they do? Acquired a further 40%. This is known as step accusation. They are not buying the full 70% together. Rather, they are buying 30% and then 40%. That means they are now gaining the control. They are becoming a subsidiary on 1st December 2003. Okay. Before they had 30, now they have 40, 30 plus 40, 70. How much? 975 million, and gain control of the company. Even if they don't say gain control of the company, it is understood. At 1st December 2003, fair value of mortgage, so they were giving the fair value at that date. Why? Because at that date you have to calculate goodwill. You need the fair value of net assets. Why goodwill on that date? Why not on 30%? Because on 40% when you acquire, that day only you became a subsidiary. When you become a subsidiary, only you calculate goodwill, not when you buy an associate. So that's why net asset also they are giving on that date, fair value of net asset. And fair value of NCI also, they are giving you 620 million. Okay, next. A gain on bargain purchase of 605 million has been recorded in the profit and loss account. What has been recorded? A gain on bargain purchase of 665 million in P&L. It's like a profit. It's like a gain. Because you are buying something, by bargaining you are reducing the cost, price of purchasing that subsidiary. That's why it's a gain on bargain purchase and it is recorded in profit and loss account. That gain. How much? 655. How? They have shown here. You have to see whether this wait. You have to see whether it's correct or not. This 975 is the cash consideration plus NCI is 620 minus 2250, which is net assets. So the formula is correct. So if it's a negative figure, for negative goodwill, we say it is a gain on bargain purchase. Okay. So which is 655. That's why we are taking it in profit and loss account as a gain. Additional buildings with a carrying amount had been included in the fair valuation at mortgage. So when you took the fair value of net assets, remember there was a building also which was 200 million. Okay. So building has a remaining. So building has a useful life for 20 years. And Joy had commissioned an independent valuation of the buildings of market which was not completed at 1st of December 2003. Okay, because the fair value of the building they cannot decide, so they have taken an independent valuation which was not complete at this one and therefore not considered in the fair value of the uniform net assets at acquisition date. Okay, so the valuations were received. When did the valuation received? On even on the day they have acquired 1st December 2003, they cannot decide on the fair value of the building. The valuation was not received. It was received later, 1st of April 2004. And it resulted what? A decrease of 40 million in the fair value of PPE at the date of acquisition. So this fair value decrease, which does not affect the fair value of NCI or acquisition as okay, it does not affect the fair value of NCI by the way. Okay, because in the NCI you need the net asset, right? But here they are saying it did not affect this fair value decrease. But has not been entered into financial statements of market the author draft consolidated financial statements. But this 40 million is not recorded anywhere, neither in the individual financial statements, neither in the consolidated financial statements. Okay, and buildings are depreciated on a straight line basis. So now with this we can answer it. Same like how we have done for previous. So you have to identify one thing. This is step accusation for mortgage. Step accusation means you need to explain it. What's happening? Okay. So Joy has achieved control over mortgage in stages. The word control and stages you need to write. On the date that control was achieved, okay, on the date that control was achieved, the previous shareholding should have been included in the goodwill calculation at its fair value, right? Isn't it? So the previous shareholding, that means the 30% associate which you had, when you are calculating goodwill, that amount should be calculated at its fair value for you to calculate goodwill. Okay. Any gain or loss revaluing this shareholding to fair value is recorded in consolidated. See, gain or loss relating to that revaluation. Where does it go? Revaluation their shareholding to fair value. Which shareholding? The 30%. Remember 30% you had initially. That will there'll be a fair value to it on that date when you have taken the other 40%. So that gain or loss will be recorded in consolidated profit or loss or in other comprehensive income also. If previously held shares were measured at fair value through other comprehensive income. That means if the 30% when you acquire those shares, if those shares were measured at fair value through OCI, then future when the fair value changes, it will go into OCI. Okay. The equity accounted investment of 700 million should therefore have been eliminated. It was equity accounted and the cost of the associate was 700 million. This should now be eliminated. Okay, because now you have become a subsidiary. Subsidiary means what? You are selling off the associate and buying subsidiary, right? So this should be eliminated. The 700 million and include in the goodwill calculation. Now you have to include in the goodwill calculation. Before it was not there because before it was an associate. Now it became a subsidiary. So include in the goodwill calculation at its fair value of 705 million. Okay. So from 700 to 705, there's a 5 million gain. Where will the gain go? P&L, consolidated P&L. Okay. In case you forgot the 700 and 705, we'll go and see here. Just see here. This has a fair value of 705, but you bought it at which price? $700. Okay, just how did you know it's 700? You need to look at the statement of the financial position. This 700, okay? Investment in associate. And the fair value was 705, so it increased by 5. That means there's a gain of 5 million. Okay. So that gain will go in the P&L. This adjustment means that the gain of bargain purchase is eliminated. Okay. Remember we got a gain on bargain purchase of this much. Now this needs to be eliminated because of this adjustment. This 5 million adjustment gain. So now what is the adjusting entry in the statement of financial position? Okay. We are debiting in retained earnings and goodwill and crediting in investment associate and retained earnings. And both the debit and credit side needs to balance. Okay. Debit retained earnings. Okay. To remove gain on bargain purchase. See, it will reduce the retained earnings because your gain you are removing, no? When you are removing the gain, profit reduces, therefore retained earnings reduces, therefore retained earnings is debit. How much? 655 because that was the gain. 655 was the gain. Goodwill, how much? Only the difference. 50 million you will debit. Why debit? Goodwill will increase. Okay. From 655 to 705. Okay. Because we told that this will be there. That goodwill calculation at its fair value of 705 million. It should be included in the goodwill calculation. Next we have investment in associate needs to be credit because we are removing it out 700 million the carrying amount, and retained earnings because it's a debit 5 million is credited because it will increase. Retained earnings will go up, profit will increase, that gain because of gain on step acquisition. When we do a step acquisition, there might be gain or loss, remember that. Okay. Just I want to go through the goodwill part. Okay, so we are done with it, and next, what is the next item which we need to deal with? Next item which we need to deal with is building adjustment. Okay, just see how they're using different subheading for each and explaining. Building adjustments. Okay, so during the measurement period, what happened? Acquire must retrospectively adjust the amounts recognized at the acquisition date if further facts and information are obtained. Retrospectively means going back and changing the previous figure. The measurement period ends 12 months after the acquisition date. The revaluation of the building's fair value at the acquisition date was determined within 12 months of the business combination, so it must therefore be adjusted because it is within 12 months of the business combination. What is within 12 months? The revision of building's fair value. Okay. This will reduce the amount of PPE and in the consolidated statement of profit and loss and will increase goodwill arising on the acquisition. So it will increase goodwill. This is the impact, and it will reduce PPE, property, plant and equipment. And they are showing the adjustment. Okay. How? Because value of the building went down, fair value. So it will reduce the PPE. And because the fair value of the building went down, building comes as a net asset. So we deduct net asset when calculating goodwill. So we are deducting by a lesser amount because net asset will reduce. No? There's a decline in the value of the building. Therefore, goodwill will increase. Okay. So goodwill will increase means debit goodwill and property, plant and equipment will reduce means credit it. So debit goodwill 40, credit goodwill 40. Because we told the decline is 40, right? Now, if the building is worth less than the original estimated, then it increases the risk that Joy overpaid for mortgage and therefore that goodwill might be impaired. However, no information is provided about this. Okay, right? So if the building is worth less than what you have estimated, it means there's a risk. That means Joy overpaid for mortgage, right? Isn't it? So goodwill might be impaired, but no information is provided about this. We are seeing for the impairment. Okay, but there's no impairment because we have not been given any information about it. Tutorial note. It is common in exams to have a charge depreciation on a fair value uplift. However, if a building was overvalued as at the acquisition date, then it's likely that depreciation subsequent charge is also too high. Definitely, if building is overvalued, depreciation also will be high, So the PPE have been included where as 200 million rather than 160. That means it was supposed to be 160, but it was recognized as 200. More, it was overvalued by 40 because we didn't take that 40 million decline. And so too much depreciation will have been charged. So depreciation was also charged too much. So that depreciation you need to take it out now. How much? 2 million. How 2 million? Because it's for 20 years and 40. The difference only you are taking, okay? Not 200 or 160. The difference is 40. So 40 million divided by 20. Therefore 2 million. Must be removed from consolidated profit or loss because depreciation goes in profit or loss only. PP is held by subsidiary and so these adjustments must be allocated. See, if an asset or liability is held by subsidiary and when you're taking it over, you need to allocate it between the owner and the NCI. Okay, because the PPC is what? It is held by the subsidiary, so adjustment must be allocated between the owners and the NCI. Same like how we have done in the previous one for uh, franchise right. Okay, so PPE, okay, it will be increasing. Okay, you need to increase PPE. It's debit 2 million. Credit return earnings because it will increase. Why credit return earnings? Because this depreciation has to be removed. It was charged too high earlier by 2 million. So that 2 million you need to add it back because it was deducted earlier. Too much of depreciation was deducted. So you add it back means profit increases, return earnings therefore credit. How much? Only the parent share. Parent share is 70% now. 30 plus 40. So 17 to 2 million of depreciation which is 1.1. And for NCI also you credit same 2 million but 30%. Okay, and add both this 1 plus 1.4 plus 0.6, it should add up to 2 million. Debit and credit should balance, should be equal. Okay. Why debit PBE? Because earlier, because of higher depreciation, we charged the property, plant and equipment value went down. But now because depreciation is reducing by 2 million, so property, plant and equipment will increase by 2 million. You're understanding? Depreciation, we have charged too much. It is supposed to be corrected now by adding back the depreciation. So when you add back the depreciation, property, plant and equipment also will increase by 2 million. That by that depreciation amount. That's why debit PBE 2 million. Now, same like how we have done for that goodwill. Correct goodwill we need to calculate. Okay. So the total goodwill arising on the acquisition is therefore 90 million, 50 plus 40. What is 50? Okay, 50 plus 40, 90 million. So here if you see increase, that means you have to add 40 debit. Okay. And just give me a minute. And here goodwill is 50. Okay. So 50 plus 40. Okay. When you have become a subsidiary, you have an associate which is 50 million, and then now it will increase further because of that building at value of building went down by 40. So 50 plus 40 is 90 million. This is the goodwill. Okay. Just give me a time to see why we didn't take the fair value of mm, mhm. So we just took the difference between the 665 and 705. The reason we didn't add the fair value of NCR minus the net asset is because it has already been taken here. So when we took the difference 655 plus 705, we have already taken it, right? So that means which is 50. So 50 plus adjustment in building will give you the goodwill. Next we have going to the third one, which is joint arrangement. But still we don't know about it since we didn't read it. So let us read. Agreement with CP we have to read. Okay. Joy is looking to expand into publishing and entering into an arrangement with content publishing, that means CP, a public limited company, on 1st of December 2003. CP will provide content for a range of books and online publications. CP is entitled to royalty calculated at 10% of sales and 30% of gross profit of the publications. Joy has sole responsibility. Sole responsibility. Okay. For all printing, binding, platform maintenance of online website, if the agreement states that key strategic sales and marketing decision must be agreed jointly. Key strategic decisions. Okay. Selects the content to be covered in the publication, but CP has the right of veto over this contract. Who has the right? CP has the right of veto. That means he can change the decision. However, 1st June 2004, Joy and CP decide to set up a legal entity. CP will equal shares and voting rights. JCP, that means Joy plus CP, equal shares and voting rights. CP continues to contribute content into JCP, but does not receive royalties. Joy continues the printing, binding, and platform maintenance. The sales and cost of sale in the printing in the period of 5 million and 2 million. The whole of the sale proceed and the cost of the sale was recorded in the Joy's financial statements with no accounting entries being made for JCP amounts due to this one. Joy currently funds the operations. Assume that the sales and costs occurred even throughout the year and all the transactions within JCP have been in cash. Okay. So here also how it should be accounted for. So it is joint arrangement. Okay, just give me a distance. Let us see the tutorial note. A joint arrangement is an arrangement over one or two parties have joint control. Remember, joint arrangements may take the form of joint operation or joint venture. There are two things. One, it could be operation, it could be joint venture. Joint venture means it involves the establishment of a separate entity. Okay. And same like associate. Joint ventures are equity method, okay, because they are using the same standard, IS 28. Both joint venture and associate are dealt under IS 28. So, for the decision to 31st May, a requirement for unanimous key strategy means this is a joint arrangement. What does it mean? They told that the requirement for unanimous key strategic decisions means it's a joint arrangement, not a joint venture. That means you need the decisions from both jointly for key decisions. There is no legal entity, is it? No. Since there is no legal entity, it is a joint operation, not a joint venture. Joint arrangement means because unanimous key decisions. So whenever you see the word unanimous, it is joint arrangement. And joint arrangements are divided into two. Joint operation, joint venture. This is joint operation because no legal entity. Because joint venture means separate legal entity. No separate legal entity, joint operation. Joint would therefore be accounted for in right wages underlying assets. So because it's joint operation, not joint venture. Joint venture, equity method, but not joint operation. Joint operation are accounted how? Right directs to the underlying results and assets. This is how you account for joint operation. So up until this one, they have the following results. What is it? That means that's why they are giving you the revenue and the cost of sales and gross profit. Okay, when it's joint operation, you need to find revenue, cost, and gross profit. But when it's joint venture, you use equity method. So here, just what is the revenue and what is the cost of sales? It has been for 6 months. Okay, until 31st May 2004. Okay, so only for 6 months because October, November, December, January, February, March, April. No, it's from May, December, January, February, March, April, May. So 6 months. Revenue is 5, cost of sales was 2 million. So you take 6 months because only for 6 months. Okay, and hence gross profit is 1.5. How much of it belongs to CP? %10% and 30% of the sale and the gross profit. Okay. So you add both. That is the amount due to CP 0.7. Let's see how we are getting 10 and 30%. Okay. Yes. They have given you that they are going to calculate royalty 10% sales, 30% gross profit. Okay. That's fine. Next. Joy had recorded all of its sale process and cost for 6 month period, hence recording a profit of 1.5 million. Joy's profit must therefore be reduced by 0.7 million. And payable of CB recorded for the same amount. The adjustment is how much? Debit P&L credit amounts payable 0.7. Okay, because profit will reduce, therefore debit. Tutorial note. The question requires you to discuss. Easier marks are available for narrative part of your answer. Okay. Discuss means you have to write. Narrative part is required, not just calculation. So on 1st of June, from this date onwards, okay, Joy has a share of net assets of the joint arrangement rather than direct right. It's no more direct right. They have the share of the net asset. of the joint arrangement. This means the joint arrangement would be classified as joint venture on that day when they have the share of net assets. Not tied it, right? Then is joint venture. That's for only for 6 months we took. And this must be accounted using equity method. Okay, in the consolidated financial statements we have no. So Joy has accounted for all proceeds and cost of joint venture. How it should be, and this should be removed from a statement of profit and loss and payable record. Transfer this back to JCP. Okay, this should be removed from a statement of profit or loss and a payable recorded to transfer this back to JCP. You need to transfer this back, so it needs to be removed from statement of profit or loss and payable recorded. So now what do you have to do? Debit 1.5 profit, credit 1.5. Okay, because 1.5 was the profit which we got. So Joy should then equity for a share of JCP's profit. Okay, equity share because joint venture of JCP's profit. How much? 1.5 into 50% because it's a joint venture. Joint venture means equally. So 50%. Okay, they don't have to give you the percentage. It's understood 50% of the profit. 0.75 billion. Okay, this will be recorded in P&L and recognized as an investment in statement of financial position. It will be recorded where? P&L, that portion, and it will be recognized as an investment in the statement of financial position. It will be recognized as an investment in joint venture. Okay, because when you make the statement of financial position, you see sometimes that under assets there are investments in joint ventures. How we have investments in subsidiaries or associates. Okay, same way. So debit it and credit P&L because it's a profit 3.75. Okay, joint venture IS 28. Under IS 28, when we are studying associate, joint venture topic is not big, too big, it's very small. So whenever a question comes on it, it should be easier for you to get the marks because the areas covered under joint ventures or joint arrangement itself, joint operation or joint venture is not too big. It's not like this small standard. Coming to part B, we have to read this. It's about shares. So joint share capital is comprised of A class shares and they have been classified as equity is considering the following instruments. B class shares that are not mandatorily redeemable but contain a call option allowing Joy to repurchase them. Okay, dividends would be payable on B shares if and only if dividends are paid on A ordinary shares. Share options which will give the counterparty right to buy a fixed number of ordinary shares for a fixed number of 10 million. Okay, now we'll see. The directors of Joy require advice as to whether these financial instruments, IFRS 9. The moment they say financial instruments, you should understand the standard they're talking about is IFRS 9. The one of the biggest and the complex standard. Okay, so the directors require advice whether this should be classified as debt or equity. Under IFRS 9 is very clear whether debt or equity, when to recognize as debt, when to recognize as an equity, in accordance with IS 32. IS 32 is for financial instruments presentation. Presentation means you present it as a debt or an equity. Okay, so this section of financial instrument is under separate standard, not IFRS 9, IS 32. Moreover, they wish to know if board proposes as outlined. So moreover means, the word moreover means this is an addition requirement. Okay, more than one requirement is there. First requirement was whether debt or equity shares will be classified as debt or equity. That is first. Second is they wish to know if both a proposal as outlined in the recent discussion paper. What is that discussion paper? DP means discussion paper, and this is issued at 1st of 2018 1. Okay, 2018 1. Financial and the discussion paper, the heading is financial instruments with characteristics of equity, which change the classification of this to instruments. Okay, so they wish to know if whatever is outlined in that discussion paper, whether it will change the classification of these two instruments or not. Okay, two requirements are there for both for 4 marks. In accordance with IS 32 presentation, discuss whether B class shares and share options would be classified as finance liabilities or equity. Second, discuss whether both proposal in this one, in the discussion paper, would change the classification of B shares and share options to requirements. You need good understanding of the discussion papers and all are like current issues and all. Okay, you need good understanding of current issues as well. So how are you going to answer debt and equity is the first thing. Okay, this is a very common exam requirement. You must memorize the definition of financial liability. Memorize the definition of a financial liability. Okay, what is it? With standard IS 32. Already they have told you. This says what financial liability is: a contractual obligation. Exactly word by word I am saying you the definition. What is given in the textbook also. Okay, financial liability is a contractual obligation to deliver either cash or another financial asset to another holder. You either have to deliver cash or it could be you are delivering financial asset also to another holder. That is known as financial liability. The word contractual obligation has to be there when you're mentioning financial liability. Okay. Equity. So you have to give the definition of the two things, financial liability and equity, because the requirement is debt or equity. So you have to give the definition according to IS 32. What is the definition of liability? Debt means financial liability, equity is equity. Second line is the definition of equity. Equity is any contract which evidences the residual interest in the entity's assets after deducting all of its liabilities. That means after you deduct all the liabilities from the asset, whatever is remaining, residue means remaining, that is equity. Okay. However, a contract may involve the delivery of the entity's own equity instruments. A contract which will be settled by the entity delivering a fixed number of its own equity instruments in exchange for a cash or another financial asset is an equity instrument. Here they are talking about own equity instruments. Okay, so there's a contract. If to settle the, it is settled by entry delivering fixed number of its own. So the moment fixed, the word fixed is very important. Fixed number of its own equity instruments in exchange for cash or another financial asset is a equity instrument. Okay. If there is any variability in the number of own equity instruments to be delivered, then the, okay, if there's a change, variability means change in the number of own equity instruments to be delivered, then the contract is a debt. That means financial liability. Two things: B shares and share options. Both you need to explain. So it is in two different subheadings. Let us go through B shares. Okay. B shares are equity. Why? No contractual obligation. There's no contractual obligation to pay dividend because we told that it's irredeemable. Something like that. So there is no obligation. No obligation is equity. Obligation means liability. It's easy. Okay, so no obligation to pay dividends. We know when there are shares, we don't have obligations to pay dividends. When company is doing good, we pay dividends. If we don't want to pay dividends, we don't pay dividends. Liability is not like that. Interest you have to pay. You have that obligation to pay interest all the time. Okay. Or to redeem the instrument also, they don't have that obligation. So dividends can only be paid on the B shares if B shares, as if the dividends have been declared on A shares. This is from the case study they are telling. Okay, this is how you link to the case study. You only pay dividends on B if you have paid for A shares, if the dividends on A share has been declared. So however, there is no contractual obligation to declare A share. There is no contractual obligation. This is the important keyword to know whether it's equity or liability, whether they have a contractual obligation or not. So they do not have to declare the A share dividends also. Coming to share option. The classification of the share option dependent on whether there is a variability in the number of equity shares delivered. Joy will settle the contract by issuing fixed number. on its own in exchange for cash. So the share options will be classified as again equity instrument because fixed. If it changes, then liability. Coming to the second part of it, the discussion paper. Here also you need to write B shares and share options. Okay. In the discussion paper, they propose to classify financial instrument as a liability if it exhibits one of the following characteristics. That's what the discussion paper says. Okay, you need to go to this discussion paper. So they say for financial liability to be classified as a liability, one of this has to be there. What is it? Number one, unavoidable contractual obligation to transfer cash or another financial asset at a specified time other than liquidation. You have to pay. You cannot say no, I cannot pay. You cannot stop willingly. You have to transfer cash or another financial asset. Then it's a financial liability. Another reason is an unavoidable contractual obligation for an amount independent of entities' available economic resources. It is independent, does not care whatever the condition of entity is. You have to pay the amount. It's like a loan. You have to pay the loan. No matter what the performance of your company is doing, whether you're making loss or not, you have to pay the interest, you have to pay the loan. Settle them off. But equity is not like that. Dividend you pay or you don't. You don't pay when you are making loss. So B share and share options. Two separate subheadings for it. So under the term of the B shares, all cash payables are avoidable, isn't it? You can avoid the cash payments under the B share. Why? You can avoid because it is not mandatorily redeemable. The shares. And dividends are not payable unless they are paid on A shares. As such, B will be classified as equity. Same by the definition of discussion paper also it's equity. Share option. Joy will be issuing a fixed number, okay, of his own shares. As such, it is not transferring a financial asset but equity. Okay, it is not you are supposed to transfer financial asset, but they are transferring equity because fixed number of own share. So the obligation to transfer fixed number of share means that Joy is promoting the option holders are they are promoting the option holders a pro rata share of his net assets on liquidation. The amount that this is worth is dependent on Joy's available economic resources. After all economic claims has been settled. So if it is dependent on the economic resources, then it's equity. As such, under the proposal, share options will still be classified as equity. You see. Now we'll see the market scheme because we have covered all the requirements. Right, the full market scheme is not there, but we can see. I think it is there. Yeah, it's there. For Hulti, 1 mark per point. For 8 marks, that means 8 point. Murgi also 8 point. CP also 6 points because 1 mark per point. Coming to part B, IS 32 classifications 4 marks and discussion paper 4 marks. Okay, so that's it, and see you in the next question. Question number 12.